Hey everyone, this is part 2 of the videos for chapter 2. Now we're going to be looking a little bit more specifically at each of the financial statements. And first statement we're going to talk about is the statement of financial, sorry, statement of financial position, also known as the balance sheet. This is where you would look at this is what you would look at to determine the value or the wealth of the business. It gives you the actual financial shape of the company just at a snapshot. So at that moment in time, this is the financial position for this company. And if you remember, current assets minus off all of your current liabilities, or if you were to sell off all of your assets, pay off all of your liabilities, the equity is what's left. And equity represents wealth. Once all is said and done, get rid of all your assets, get rid of all your liabilities. This is the value that's left for the company. Then our statement of income, again, several different names that we've heard for this statement. Um, Most specifically, we've talked about it as the income statement. It's also referred to by some people, which is a very old expression, profit and loss statement or P&L. Statement of operations is also another name for it. Statement of operations would exclude um, any income that comes from things other than the day-to-day operations. So it wouldn't be the same as the statement of comprehensive income. On the statement of comprehensive income, you would have all of your um, activity for your operations, and then at the bottom of that, that's when you would add in the other comprehensive, as you can see back on page 45, where we've talked about that before. All right, and then the statement of changes in owner's equity or statement of retained earnings section is also where you'd find out what the value of the common shares are that have been sold by the company, and then the earnings that have been retained in the company. It's just a new name now, whereas before it used to be the net income that was kept in the company. So if you remember back to when we looked at sole proprietorships and partnerships, your statement of equity was opening equity or capital from January 1st, plus any investments by the owner, minus off any withdrawals by the owner, and then add in your net income. And then that would give you your ending balance for your equity or balance for capital as of December 31st of that year. So your statement and changes in equity, where we're talking about corporations now, where we sell ownership through common shares, the value that those shares were sold for, and then the earnings are now referred to as earnings retained in the company or retained earnings. This slide gives a good depiction of the flow. However, there is an error on it. So I'm leery as to talk about it too much. But basically what's going on is your statement of income. You're showing that revenue minus off all of your expenses to give you the profit or net income for the year is 100,000. Then when you carry it over to your statement of retained earnings, you've got your beginning retained earnings plus your earnings for the year. Then we've got dividends. That is how the common shareholders get money out of the company. So say the chief financial officer or the chairman of the board declared dividends for the year. The amount of dividends was 20,000. Then the amount of retained earnings from that year is 80, so an additional 80. So the beginning plus the new amount gives you the new ending retained earnings. Well, that new ending retained earnings is what's supposed to be carried over here on their statement of financial position, just like what we talked about in Accounting 1 and Accounting 2. Your statement of owner's equity, the ending balance is what gets carried over to your balance sheet. So just unfortunate that they have a little bit of an error in their slide here, but please don't let that confuse you. Okay, so moving on. They just have a picture of your income statement. Then we are going to look at statement of comprehensive income. So you've got your regular activities from the day-to-day operations. Then we get into the profit for the year, and then other comprehensive income. And if you have a look on there it is. Page 55, it talks a little bit more about what is other comprehensive income, as well as giving you a little review of it here. So again, any gains or losses due to exchange rates, or if you've had to revalue an asset because you're now going to sell it, that could lead to either an increase or a decrease or a gain or a loss that affects your comprehensive income. But again, we're not going to be getting into that too much in this course, so don't let that confuse you. Okay. So again, we have our profits for the year, and then that profit of 40,000 is carried down into our statement of retained earnings, minus off 20,000 dividends. So we decided to do a payout ratio of 50%. What that means is of our earnings from that year, which is 40, our dividends are 20, which is half, or we're paying out 50% of our earnings as a dividend. Okay, they're introducing a new phrase over here as well. EBITDA, which is if you come up back over under your statement of income, you'll see your operating income, which is called EBIT, earnings before interest and tax, which is 75,000. The EBITDA or EBITDA just adds back the depreciation. So it tells you what your operating income would be even before your depreciation is subtracted off of there. So you'd add back the 25 to the 75 to say that your EBITDA is 100,000. Okay. So on our statement of changes in equity, as you can see, our share capital, or the value that we've collected by selling common shares, we had an opening balance in 2013, which came from our ending balance in 2012. Then we sold another $15,000 worth of shares in 2013 to give us an ending balance of 200,000. Okay, the retained earnings, again, the retained earnings for the beginning from 2013 comes from the ending for 2012. As you saw in previous slides, we had earnings for the year of 40,000. We paid out 50% of those earnings in dividends, so we subtract off 20,000 to give us an ending balance in our retained earnings of 155,000. So if you look over here, I flipped forward a couple of slides to come over to our balance sheet. So we have our share capital, as you saw from the previous slide, of 200,000 plus the retained earnings of 155,000 to give us total equity of 355,000. All right, we are now at pretty much the 10-minute mark. I am going to be creating another slide, or sorry, another video for the remainder of the slides. Please let me know how you're making out with these and if there's any more confusion or any confusion on any of the topics. I know there's quite a bit of new terminology in here, and I hope that my videos are helping to clear that up. Thanks, everyone.